Welcome to the Radio Revenue Podcast. So usually, when you walk into a bar, or maybe you're just browsing the aisles of your local liquor store, you always see that square bottle of Jack Daniel's sitting right there on the shelf.
Oh, yeah. It's iconic. You can spot it from across the room.
Exactly. And there's this baseline expectation of simplicity with it, right? It's whiskey, it's a glass bottle, you've got the familiar black label, and some amber liquid inside that just took a few years to age. You buy it, you pour it. It feels like a very clean, straightforward, almost timeless transaction.
Right. And it creates this illusion, I think, of a brand that's just completely unbothered by the outside world, like they're just making whiskey in a quiet barn somewhere.
Yeah,
But, the moment you look past that label and actually step into the realities of corporate finance or global supply chains, macroeconomic pressures, that simple bottle of whiskey becomes this incredibly complex mechanism.
it really does. It's almost deceiving.
It is. It's like looking at a massive suspension bridge. From afar, it's just this elegant, static silhouette against the sky. Right? But then you get up close, and you realize it's thousands of tons of steel under immense constant tension. It's continuously shifting and adjusting to the wind just to keep from collapsing.
And that tension is exactly what we are going to explore today. We're taking a deep dive into an exclusive look at Brown-Forman's fiscal year 2026 annual report, their Form 10-K.
Which is quite the read, let me tell you.
Oh, it really is. Our mission here is to uncover how a 150-year-old heritage titan of the spirits industry is attempting to navigate a brutal, modern macroeconomic hangover.
Yeah, they're really in the thick of it right now.
They are. We are looking at a company that is literally ripping up its historic playbook. I mean, we're talking about laying off workers, selling off centuries-old barrel-making operations, and just completely overhauling the logistical pipeline of how their liquor actually gets from a distillery onto your local shelves.
Okay, behind that single bottle of Jack Daniel's is a $3.9 billion global empire.
Billion with a B, yeah.
Exactly. We are looking at an operation that employs I think it's 4,900 people across 170 countries. And right now, today, they are battling persistent inflation, rapidly changing consumer habits, and a highly unforgiving global economy.
Okay, let's unpack this. Before we can truly understand the massive restructuring and, all the structural pain this company is voluntarily taking on right now, we first have to understand the sheer weight of what they're trying to protect.
The portfolio.
Right, the portfolio is massive. We are talking over 40 distinct brands. You have Woodford Reserve, which is moving, 1.9 million cases globally?
Yeah, almost 2 million cases. It's huge.
You have El Jimador Tequila. You have recent super premium acquisitions like Gin Mare and Diplomático rum.
Right.
But let's be entirely real here. Jack Daniel's Tennessee whiskey is the undisputed king.
Oh, without a doubt. It is the #1 selling American whiskey in the world. Period. And even now, in 2026, they are still just sweeping the industry awards. Jack Daniel's 14-year-old just won World's Best Tennessee Whiskey, and their bonded version won Best Tennessee Whiskey with no age statement.
Which is incredible. It makes me think of, a major movie studio. Jack Daniel's is the Marvel Cinematic Universe for Brown-Forman.
Oh, that's a great way to put it.
Right. It is the foundational, massive tentpole franchise that funds absolutely everything else. It pays for the experimental indie films, the niche romantic comedies, the new tequila acquisitions. If the tentpole collapses or even just sags a little bit, the entire studio is in deep financial trouble.
What's fascinating here is that Brown-Forman actually knows this.
Yeah.
And they explicitly admit it to their investors.
They put it in writing.
Oh, yeah. In a Form 10-K, a public company is legally required to list its risk factors. They have to formally document the specific threats that keep their executives up at night, just so investors know what they're buying into. And the very first risk factor lifted in this 2026 document is their, and I'm quoting here, substantial dependence upon the continued growth of the Jack Daniel's family of brands.
Wow. #1 on the list.
#1. That is a staggering vulnerability for a multi-billion-dollar multinational company. Like you said, if Jack Daniel's catches a cold, the entire 4,900-person global operation gets the flu.
And it isn't just the classic Oldham 7 anymore either. They have expanded that Marvel universe aggressively over the last 15 years, specifically to protect and widen that revenue stream.
Right, all the flavor extensions.
Yeah, they launched Tennessee Honey, Tennessee Fire, Apple, and most recently in 2025, Tennessee Blackberry. Plus, they're layering in these premium age statements, the 10-year, 12-year, 14-year bottles. They are just trying to extract every conceivable ounce of value from that single trademark?
They are completely blanketing the market.
Yeah.
The strategy is clearly to capture consumers at every possible price point and, flavor preference, all under the safety umbrella of a brand name that people already trust.
Makes sense.
If consumer tastes shift toward sweeter liqueurs, they have honey. If the market shifts toward ultra-premium sipping whiskeys, well, they have the 14-year. But as robust as that product lineup is, manufacturing an award-winning liquid is really only half the equation.
Yeah, getting it from the distillery in Lynchburg, Tennessee, to the shelf at your local store is the other half. And that brings us to the most aggressive, frankly shocking changes Brown-Forman has executed in over half a century. They are basically tearing up the floorboards of their own business.
They really are. In fiscal year 2025 and 2026, we see a company fundamentally altering its physical and structural DNA. Let's start with their route to consumer, which is the industry term for how they actually distribute their products.
Because in the U.S., it's pretty complicated, right?
Very. In the United States, spirits manufacturers generally cannot sell a bottle directly to you, the consumer.
Right, because of the classic three-tier system left over from the end of Prohibition.
Exactly that. Producers sell to distributors. Distributors sell to retailers. Retailers sell to you. And in some states, known as control states, the government actually acts as the distributor or even the retailer.
It's a maze.
It's a total maze. And Brown-Forman is currently implementing the most significant evolution of their U.S. distribution network in over 60 years. They transitioned their distribution network in California, which is an absolutely massive market for them, effective May 2025.
Okay, California, huge.
Huge. Then they transitioned 13 other markets in August 2025 and followed that up by overhauling 11 control states in June 2026. This is a multi-year, highly complex, and incredibly risky transformation of their entire logistical backbone.
But why take on that kind of logistical nightmare now? I mean, changing distributors in California alone sounds like a recipe for missed shipments and empty shelves if things go wrong.
Because the old system was likely bleeding efficiency. By consolidating distributors or renegotiating these massive regional contracts, a company can usually secure better placement on retail shelves. They can prioritize their premium brands and ultimately just squeeze better margins out of the middleman.
So it's a long-term play.
Yeah, but you are right. The transition itself is a monumental task that absolutely disrupts short-term sales.
And that's just the stuff outside the corporate walls. Inside the walls, the restructuring was severe. They executed a cost-cutting measure they officially call a restructuring initiative, which reduced their worldwide headcount by 12%.
Yeah, 1 in 8 people.
When a family-run company that historically prides itself on this tight-knit corporate culture suddenly cuts 12% of its global workforce, you know the macroeconomic alarms are blaring in the boardroom. But out of all the changes in this 10K, the thing that absolutely stopped me in my tracks was the cooperage.
Ah, the Louisville-based Brown-Forman Cooperage.
Yes, they closed it and sold it. They sold the physical facility and the related manufacturing assets for $33 million in cash. Now, I have to push back on this strategy because this does not make sense to me.
Oh, so?
Well, under U.S. federal law, bourbon and Tennessee whiskey must be aged in new, charred oak barrels. You cannot reuse them. Wood is literally a legally mandated ingredient in Jack Daniel's and Woodford Reserve.
That's true. It's the law.
So barrel making the cooperage is a massive part of their lore, their marketing, their craftsmanship. How does a whiskey company not own its own barrel factory? Aren't they risking their entire quality control by outsourcing the very thing that gives the whiskey its flavor?
If we connect this to the bigger picture, it actually makes a profound amount of financial sense, even if it, completely shatters the romantic lore of the brand. What you're seeing is a classic corporate transition from a heavy asset manufacturing model to an asset-light brand building model.
Asset-light, meaning they want to own the intellectual property, the recipes, and the marketing, but they don't want to own the heavy machinery.
That is the core of it. Running a cooperage is essentially running a heavy industrial lumber and manufacturing business. It requires massive physical overhead, intense labor costs, endless maintenance on industrial saws and kilns.
Just massive expenses.
Massive.
Yeah.
And significant capital expenditures just to keep the building compliant with safety regulations. By selling the facility, they immediately shed all of that operational weight, the associated headcount, and the drag on their profit margins.
But they still need millions of barrels. They can't make Jack Daniel's without them. If they are buying them from a third party, how do they guarantee the wood is toasted and charred exactly the way their master distiller demands?
They do that through the second half of this transaction. When they sold the cooperage for $33 million, they simultaneously secured an $88 million supply contract intangible asset.
Okay, what does that mean in plain English?
In accounting terms, they baked a guaranteed ironclad contract right into the sale. The buyer is legally obligated to continue supplying Brown-Forman with the exact barrels they need, built to their exact proprietary specifications to meet their legal aging requirements for the next 7 years.
So they get the exact same barrels from the exact same factory, but they don't have to deal with the headache of actually running the factory.
Exactly. They traded a physical asset, wood, steel, and real estate, for an operational asset.
Yeah.
Agility. They are fundamentally transitioning from being a manufacturer of wood products to being a pure marketer and builder of spirits brands.
Wow.
This improves their return on invested capital, which is a metric Wall Street absolutely loves because they're tying up less of their own cash in heavy machinery.
So what does this all mean? Did shedding all this heavy manufacturing weight, firing 12% of their staff, and upending a 60-year-old distribution network actually help their bottom line? Did this incredibly painful corporate surgery work?
Well, to answer that, we have to look at the cold, hard financial realities of fiscal year 2026. And the short answer is, the restructuring has not yet shielded them from the broader economic storm. The numbers for FY 2026 are rough.
Rough is putting it mildly. I mean, I'm looking at the income statement right here. Net sales are down 1% to $3.9 billion, but operating income is down 10% to $1.0 billion. And diluted earnings per share EPS is down 17% to $1.53. Why the huge gap?
It's a big discrepancy.
Yeah. If sales only dropped by 1%, how did their operating income fall off a cliff by 10%?
That gap is the definition of margin compression. When your sales volume drops even slightly, your fixed costs, like the massive distilleries, the marketing budgets, the corporate headquarters, they don't automatically shrink to match.
Right, the lights still have to stay on.
Exactly. Plus, remember that 12% headcount reduction? Laying off that many people requires massive upfront severance packages. Those restructuring costs hit the operating income directly this year, even if they save the company money 3 years from now.
Okay, but there is another massive line item dragging down that operating income. The 10K details a $132 million non-cash impairment charge on those super premium acquisitions we mentioned earlier, Gin Mare and Diplomático.
Yeah, that's a tough one to swallow.
For the listener who might not be a forensic accountant, what exactly is an impairment charge? Because $132 million sounds like a terrifying amount of money to just vanish from a balance sheet.
Let's break down the mechanics of an impairment charge. Imagine you buy a house in a booming neighborhood for $1 million, well over the asking price, because you firmly believe the area will keep getting more popular. In corporate accounting, that premium you paid over the raw value of the physical assets is called goodwill.
You are paying for the brand reputation, the future potential.
Yes. Brown-Forman bought Gin Mare in 2022 and Diplomático in 2023, right at the absolute peak of the post-pandemic super premium spirits boom. They paid a massive premium because people were buying expensive gin and rum to mix craft cocktails at home.
I remember that phase. Everyone had a home bar cart suddenly.
Right. But fast forward to 2026. The 10K notes a softening category and a challenging macroeconomic environment in Europe.
Which means the neighborhood you bought that house in is suddenly losing its value.
Precisely. Inflation and high interest rates in the Eurozone have crushed consumer confidence. Consumers are experiencing what the industry calls trading down. Instead of buying a $45 bottle of Gin Mare, they're buying a $25 standard gin.
Ouch.
Because the future earning potential of those brands has dropped, Brown-Forman's auditors require them to admit they overpaid. They have to write down the value of those brands on their balance sheet by $132 million.
So it's a non-cash charge. They didn't actually write a check for $132 million to anyone this year.
Correct. The cash already left the building years ago when they bought the brands. But it is a massive hit to their reported profitability today. And it signals to investors that their past strategic bets aren't paying off the way they originally modeled.
Here's where it gets really interesting, though. If you look at the stock performance graph included in the back of the 10K, it is brutal. They are legally required to show a 5-year cumulative total shareholder return compared to a broader index. If you invested $100 in Brown-Forman stock on April 30th, 2021, by April 30th, 2026, your investment was worth just $37.
A 63% destruction of shareholder wealth over 5 years. It's staggering.
Meanwhile, That exact same $100 invested in the S&P 500 index grew to $185. It is like showing up to a roaring bull market party with a completely flat keg. The
Yeah.
broader stock market soared over those 5 years, creating massive wealth, and Brown-Forman sank like a stone.
Yeah, they completely missed the rally.
I look at this and wonder, how does an executive management team survive that kind of prolonged underperformance? If this were a typical publicly traded company, activist hedge funds would be storming the gates. They would be demanding the CEO be fired, the board be replaced, and the company be sold off in pieces.
This raises an important question about corporate governance, and we're touching on the absolute secret weapon, or the Achilles heel, depending entirely on your perspective of Brown-Forman. They are legally classified as a controlled company under New York Stock Exchange rules.
Let's define that. What does being a controlled company actually mean for the average investor?
It means they operate with a dual-class share structure. They have Class A voting shares and Class B non-voting shares. And the Brown family, the actual descendants of the original founder from 1870, they still own more than 50% of the Class A voting stock.
Ah. So Wall Street analysts can scream, activists can write angry letters, but the family holds all the voting power. They are immune to a hostile takeover.
Entirely immune. The 10K explicitly warns you about this in the risk factors. It states in plain English that the Brown family's interests might not align with short-term institutional investors. Wall Street operates on 90-day quarterly earnings cycles. If you miss your quarterly target, your stock gets punished.
But the Brown family isn't playing that game.
The Brown family does not care about the next 90 days. They operate on multi-generational timelines. They have been steering the ship for over 155 years.
Which perfectly explains their current strategy. This dual-class structure is the only reason they are willing to stomach a brutal 5-year stock slump. It explains why they are willing to absorb massive restructuring costs, fire 12% of their staff, and sell their beloved cooperage today.
Yes, exactly.
They aren't trying to juice the stock price for the next earnings call. They're taking the pain now to ensure Jack Daniel's is still the undisputed king of global whiskey 50 years from now.
They're willing to look bad today to survive tomorrow. It is a luxury that almost no other publicly traded company of this size actually has.
So bringing this all back to you, the listener, why should you care about the financial plumbing of a Kentucky whiskey company? Because this 10K is a perfect microcosm of today's global economy. Even a 150-year-old Titan, the company that holds the keys to the world's most famous whiskey, is being squeezed from every direction.
They really are.
They're fighting the same inflation you are. They're dealing with changing consumer habits. They even highlight their own pause campaign in the report, which promotes mindful drinking, directly acknowledging the cultural shift where younger generations might simply be drinking less alcohol.
They're also dealing with severe supply chain vulnerabilities regarding natural ingredients like wood for their barrels and agave for their tequilas.
Yeah.
Climate change and agricultural yields directly impact their bottom line. Nobody, not even a multi-billion-dollar Titan, is immune to the macroeconomic hangover.
What we are seeing is a legacy giant trying desperately to modernize its infrastructure. They are shedding physical weight, transitioning to an asset-light model, and taking incredibly painful financial hits today entirely to protect their golden goose Jack Daniel's for tomorrow.
It's a huge shift.
It is a high-stakes gamble. They are betting that becoming a leaner, brand-building machine will eventually turn that stock chart back around. But looking at the broader industry, it makes you wonder about the ultimate endgame here.
It really does. And I want to leave you with a final thought to mull over. We are seeing global consolidation accelerate at a breakneck pace in the international beverage industry. Giant conglomerates like Diageo, Pernod Ricard, and Bacardi are constantly snapping up every successful independent brand they can find to build out these massive, diversified global portfolios.
Right, they want to own every category in the bar.
Exactly. So the lingering question becomes, how much longer can a family-controlled, single-category dominant company like Brown-Forman remain entirely independent? If the stock price continues to languish at $37 and the macroeconomic pressures in Europe and the U.S. don't ease, at what point does the pressure on the Brown family to finally sell their crown jewel to a conglomerate become insurmountable?
That is a fascinating multi-billion-dollar question. If the Marvel Universe continues to struggle at the box office for long enough, eventually someone with deeper pockets is going to try and buy the studio.
Agree.
And that brings us right back to where we started. The next time you see that simple square bottle of Jack Daniel's sitting quietly on a bar, just remember the sheer scale of the corporate machinery, the logistical overhauls, the sold-off factories, the margin pressures, and the multi-generational family drama keeping it on that shelf. It is a whole lot more than just whiskey in a glass.
Couldn't have said it better myself.
It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.